Some of you have asked me about building an ETF portfolio versus an index portfolio. In this video, I want to tell you what I found to be the differences in creating a portfolio with an index fund versus an ETF or exchange traded fund. Hi, I'm Camille Gaines here, and on my website, retirecertain.com, I write about and talk about my own investing adventure over the past 40 years or so, as well as creating multiple income streams over the past 15, 16 years now, along with my husband after an accidental stumble into early retirement. An ETF fund or an index fund can be an excellent way to build a diversified portfolio. Really low cost, if not, well, it can't be free because there is the management cost of both the ETFs and the index funds, and we'll talk more about that in a second. But as far as commission basis, there's no wealth management fees as far as a commission basis. Now, some financial advisors even use ETF funds or index-based mutual funds for their clients. So this isn't something that's strictly a DIY type of investment strategy that's only for self-directed investors. This is a strategy that everyone can use. It can be sophisticated or it can be extremely basic with just a stock and bond portfolio in it, either ETFs or index mutual funds. All right, in another video, I've explained what index funds are, but if you're watching this video, you probably already know, so I'm not going to go into that. I'm going to dig straight into the pros and cons of each. And the very first thing I want to talk about is implementing an ETF fund versus an index mutual fund. Okay, so one of the things that's really different is that with an index fund, there's only a closing price at the end of the day, and that is called the net asset value, and that's based on the assets that make up the fund, the underlying assets. So for example, an index fund will buy an S&P 500 index fund, will buy the 500 securities, for example, in that index. So that the value of those securities at the end of the day, that's what makes up the pricing or the net asset value of the mutual fund. So you may during the day go online, log into your broker, maybe even still call your broker or whatever to buy that index mutual fund, but the pricing doesn't happen until after the market closes, because that's when the net asset value is calculated. Now, as I understand it, some mutual funds are not even calculated every single day, but most of them are. Certainly most of the widely traded mutual funds that you hear about and probably that you're involved with. So net asset value, end of day. All right. So on the other hand, with ETFs trade just like stocks. I can log into my brokerage account and I can buy ETFs, create an ETF portfolio. In fact, that's exactly what I do. Now, I've also bought mutual funds in the past, but now I use ETFs. And so you can do that right from your brokerage account. So I can log in and just purchase that right there, and boom, the price fluctuates during the day based on supply and demand during the day, the market value during the day. And sometimes, in fact, and I'll confess, I didn't realize this until I was doing the research for this video, and that is that sometimes the underlying assets can be the total of the underlying assets that make up the ETF can be a little bit different from the market price of the ETF itself. But I've never noticed that to be an issue. So the ETFs that I purchased are, however, very actively traded. And I suppose this would be more of an issue maybe with not actively traded ETFs. So that's the very first thing, is the way that you implement is different for index funds and ETFs, and the pricing is different. So you don't know exactly, I guess I should also add, you don't know exactly what you're going to pay for an index mutual fund, because the price could be different by the end of the day, right? You don't know exactly. Whereas with an ETF, you know exactly. I mean, there may be a little difference between the bid-ask spread, and if you put in a market order, it may be a little different. But generally, you know what you're paying for an ETF. So that is another difference in the two. The next thing I want to talk about is costs of ETFs versus index mutual funds. The costs are very similar. There's usually no cost to buy them unless, like I was saying earlier, sometimes you pay a financial advisor to manage this for you. But if you do it yourself, then there's no cost to purchase most ETFs or index mutual funds. Now, there may be, I would say there would be maybe some index mutual funds that still charge, believe it or not, commissions, front load commissions, or possibly definitely commissions on the back end. But you can usually find almost anything that you want that's more actively traded for free now from a standpoint of purchasing it. Now, like I was saying earlier also, though, there will be some management fees, but those management fees can range anywhere from just T90, I say like I'll see it on the information like 0.02, for example, on up to maybe 0.8. Okay, so that would be like half a percentage point would be in there. So we're talking about really small. We're talking about under 1 percentage point. So most of these are very cheap. This isn't always the case. You will find definitely some funds that are more expensive and probably some ETFs that are more expensive as well. But you can find index mutual funds and ETFs that are very inexpensive. And so be on the lookout for that. The costs, though, are similar. The next thing I want to mention is taxes. ETFs are slightly more tax efficient than mutual funds. Maybe I shouldn't even say slightly. They are more tax efficient than mutual funds. Okay, with mutual funds, and I learned this the hard way back like in the 1990s, and my dad actually warned me about this. You can purchase a mutual fund that's about to make a distribution of capital gains and or supposed dividends. But anyway, capital gains, let's say that the mutual fund has gone up in value and you have to pay taxes on it because you bought it, but then you didn't get the benefit of that rise in value. So that's one thing that can happen with mutual funds is there can be transactions inside of the mutual fund that triggers taxes on the fund itself. Another time that can happen, and I've really seen it happen when I've invested through bear markets, and I've been in index mutual funds, is that investors panic when they panic. And I don't know if you saw my other video about the market cycle emotions of investors. If not, check that out. But investors tend to panic near the bottoms of market cycles. And so what happens is they start selling their index mutual funds, and the companies that run those funds have to sell the underlying securities in order to come up with the money to pay the investors that are wishing to liquidate, to sell their funds. And so that can be very unfortunate for mutual fund investors. So that is one disadvantage. ETF funds are structured differently so that they don't, usually investors don't incur capital gains inside of the funds itself. Now, having said all of that, let me say that as investors, we all have to, or not all of us, I guess it depends on what tax bracket you're in and what your situation is. But as an investor, I certainly have to pay if I buy and sell a mutual fund or an ETF, and I make money on that. Okay, so that's my gain on the fund itself. What I was referring to earlier are the gains and or losses possibly within the fund that triggers taxable transactions. But there are also the gains or losses that can occur just from you buying and selling the fund. Bought it for $100 and you sold it for $200. 2 years later, you've had a long-term capital gain. Now, if you sell it within a shorter time frame, in under a year, then you would have had a short-term capital gain. All right, so those are taxes as it relates to mutual funds, index funds, versus ETF index funds. This is a lot of fun talk. Okay, the next thing I want to point out is the ease with which you can manage a portfolio of index mutual funds versus ETF funds. And both index mutual funds and ETFs are really, really super simple to manage, especially if you're more of a passive investor that buys things and holds them no matter what happens in the market or the economy. I don't, but a lot of people, most people do. And so they're both really easy in that regard. Now, having said that, I really like ETFs in relation to the ease of use because I can log into my brokerage account and I can look at really good charts I like looking at charts and using charts when I invest, especially if I'm investing outside of my structured ETF portfolio. So I do like that about ETFs over the mutual funds. Well, you can absolutely find charts for mutual funds. It's just not as extensive as what I can find in my brokerage account with ETFs, because the data is there like it would be with stocks. The next major difference with ETFs versus mutual index funds is that with ETFs, you can sell covered calls against the underlying asset that you have or the ETF that you have. And I like covered calls for people that already have stock market exposure anyway. They're risky from the standpoint that they do involve stock market risk. But having said that, and there are some pros and cons to covered calls. I've done several videos on that. You can check it out. But basically, a covered call allows you to sell the right for someone to purchase that ETF from you at a set price. And the income that you can get from selling covered calls is 2 to maybe 10 times dividend income, maybe even more than 10 times dividend income. So if you own stocks anyway, it can absolutely make sense to sell covered calls. Now, having said that, it's not just stocks. You can sell covered calls on ETFs that are commodity ETFs or gold ETFs or different types of ETFs. So bond ETFs, although the volume is a little bit lower on those. But having said that, you can easily sell covered calls against ETFs. You can't do that at all with mutual funds. Mutual funds, that just is totally not an option. That's what I want to share with you in this video. Most of all, remember, retire certain.